All right, stocks finished last week on a high note. Seemed to be a new trend, finishing on Fridays near the high of the week. It started the week. We had kind of changed the trend for starting Mondays with a little bit of a decline off of the lows usually, but usually gapping down on Monday. That wasn't the case today. We started up a little bit and we continued higher throughout most of the day and finished with a new 4-week high, finished with a new 52-week high. So good move here today to start off the week. We'll see if it ends up being the low of the week today or the high of the week by the time we're done with the CPI report and the FOMC meeting, the all-important FOMC meeting. So we'll break down kind of how the charts are looking like going into what is now week number 7 of this rally, day number 30 when you're counting just the actual trading sessions. So we'll break down again this move, kind of what the indicators are, a few exhaustion patterns that showed up here today. I'm going to show you what those look like within the charts that we typically look at day after day. And then we'll take a look at how today's move impacted some of the signals that we've been talking about over the last few market outlook videos. Trade Ideas, a stock that's one of the Magnificent Seven that didn't have a good day today. They all suffered. It was kind of an anomaly though, and we'll talk about how to trade one of them that happens to be kind of in a sideways trend, even with today's bigger loss, still stayed in the sideways trend. We'll talk about how to trade that. So let's go ahead and get started. Today is Monday, December the 11th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter, for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these things over here on the right, including our Market Outlook live video I do when I do it on the Monday, Wednesday, and Fridays at 3:30 Eastern time. Come down to the bottom, click on this heart. It opens up this tab. Hit that like button there. Same thing here. Click on this thumbs up icon. It takes you to this tab. Hit that like button. Again, the more you do that, it helps get our content out to our followers on those platforms. It's really important for us. That's why we always ask. Our goal is to get to 100 likes on our tweets day after day. Thank you to those who do like these. For those who don't, you can do it right now while you're watching with 1 or 2 really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, the intermediate line remains above the 90th percentile. Again, this is like a long, even if you go back to like last August, we haven't been above the 90th percentile for this long. Here it is over here in August. You can see we were above for about this. I guess you could argue it was about this long. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 13, 14, 15 days, and then we dropped below on the 16th. So 15 days above it, and now we are 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22 days above it. So this is an extreme, way more extreme, like I said, than what we saw back here in August. Very, very strong move to the upside. Of course, the near-term line, after a shallow decline and a shallow increase, another shallow decline, another shallow, and potentially another shallow increase. We'll see. It's hard to get started on a new long run like this one when you haven't had a good near-term pullback, right? And this was a near-term pullback. It just again wasn't even close to we still haven't even come close to retracing 23% of the first near-term decline. Again, very similar to what we saw in other instances where we've been this bullish. So the momentum line did fall, but it did fall out of the reversal zone, but that's not surprising. It doesn't stay in there for very long. At least it's still in bullish territory. Market sentiment line still rising. It will get into bullish territory at the pace that it's going. We're still above, more than 2.5% above the 30-day moving average. Again, you go back to August of last year, and we were above it for a pretty good chunk of time as well that entire time. You can see here we are again. Same. And we were in there in August, a good chunk of time here too, in December, being above it. And then there you can see kind of up and down, but we've been up this entire time. We never have fallen back below that 2.5% mark above the 30-day moving average there. So good, strong move. Very similar move on the NASDAQ, of course. The NASDAQ showing very similar momentum line at the lower end. Market sentiment line actually is in bullish territory already. The intermediate line did pull. We did get a little bit more of a pullback than what we saw here. If I were to now activate this, you can see because the near-term line never did come back up here. So this was all one big near-term decline. On an intraday basis, it actually got to the 23% retracement. And then we've now rallied up to new highs. Strong near-term line. The momentum line did not get up there, unlike the S&P. See, the S&P, the momentum line did get in the reversal zone. The NASDAQ did not. So you have a very strong near-term move without the momentum line preceding that. Makes you worry about that move a little bit, that near-term move a little bit. And then finally, the Russell 2000, which got a cluster here last week, is kind of in the mode of a near-term divergence, right, where we might get a lower high point here with the higher high, slightly higher high that we're getting right now. So we'll keep our eyes on that, which is important because now you'll see the Dow Jones Industrial Average has also got a cluster. Look at that cluster on the Dow Jones. I mean, that's, again, a pretty tremendous move for the Dow Jones, considering, again, 30 stock index, right? We've now been on this move for 30 days. Off of that low point. So if I were to go rate of change and ramp this up to 30 days on both of these, and then put the Dow Jones Industrial Average in here, because again, it doesn't have the same exposure to the Magnificent Seven. It only has 2 of them in it. But if you take a look, again, up over 12%. Again, we were higher back last time the market was pricing in rate cuts to a large degree. We were up higher than that in a 30-day time frame, but again, this is a strong move that we've seen, usually coming off of significant low points, and this was hardly a significant low, hardly a washout low on multiple levels, whether it's volume or trading range. I mean, the market's behaving. I tweeted out something about consumer staples and how many stocks are above their 50-day moving average versus their 200-day moving average. Again, it's the same ratio on that tweet as other major market lows, like bear market lows, like well below the 200-week moving average lows. And of course, we never did get even to touch the 200-week moving average here, much less get a VIX very high. And the CAPE ratio is already in the 30s. So the market's behaving like we're coming off of a major market low point, but obviously we're not, because we haven't had that decline past the 200-week moving average at all, nor did we ever have like I said, the washout phase before. Let's take a look at the weekly chart here, and you'll see again the size of the candle, the Hakinyashi candle, is still below its moving average, so that we're getting smaller. It doesn't mean that we have to reverse, but it does mean that we're losing this momentum. We are, 7 weeks, 1, 2, 3, 4, 5, 6, 7. It's not common to get a 7-week rally to the upside. If you take a look, go back 20 years, and you look at 7-week rallies here, this would be 7 weeks. It's not very common. The last time we had it on SPY, it was back here in 2017, there in the fall of 2017, where we were up 1, 2, 3, 4, 5, 6, 7, 8 weeks in a row, and really only 2 of them exceeded a 1% increase during that streak. We had a 6-week streak earlier in 2017, very, very low volatility period. But again, you can see we've had 3 above 1%. We've had 2 above 2%. Of course, 1 almost nearly 6%. And this one was right on 1%. So we actually had 4 1% gains or higher, and almost a fifth there, just a little less than. And with the weekly implied volatility below historical volatility, which is also not very common and typically leads to an increase in implied volatility. But needless to say, we're on a pretty good streak that's not very common at all there. And you can see that here. Again, you've already got a higher high. So we checked that box off. And as of right now, we have a higher Hakinyashi close. So that's bullish still. The PPO is still rising. So the only thing that's really kind of not as bullish is the fact that the size of the candle is below its average. But at least it's still above zero. At least it's still a positive candle. It hasn't turned negative, nor do we have a transition candle yet where you get an upper and lower shadow and a lower close. So we don't have that quite yet. If you take a look at the 3 green arrows charts, you can see again the S&P still does not have 3 green arrows. The MACD still doesn't have the arrow, nor does the NASDAQ. The Dow Jones Industrial Average got the red arrow on the, remember it's got the cluster, but it has a red arrow on this MACD, so it's also not green, 3 greens. The Russell is still 3 green, has been. It took the longest to get to the 3 green arrows and still has it, while the others, like the S&P and the NASDAQ, haven't had 3 green arrows for quite a while here. Looking at breaking those lines apart, you can see why. The MACD, which had spiked up to extreme high levels, and the histogram's already peaked. The MACD itself has already peaked. We're in convergence mode, and we're still in convergence mode. This doesn't mean that we're going to continue to move higher. It just means that you can be in a bullish convergence mode for quite some time. Let's see if I can find another period where we had a little bit longer of a convergence period. A lot of these peaked pretty quickly. But if I were to zoom out, really this would be the last time that we had such a long convergence period, going into the end of 2021, where we were below. MACD was a red arrow, and the stochastics kind of formed a little bit of a lower high, divergent high, but we stayed above the 8-day moving average that entire time, something similar over here too. So that's kind of what we're getting right now. We've been have the red arrow for 1, 2, 3, 4, 5, 6, 7, 8, 9 days, and we've been above the 8-day moving average for all but one of those 9 days. So that's kind of what we're seeing there. The Qs kind of showing the same pattern. Above the 8-day moving average. MACD is still below its moving average. Stochastics has crossed above its moving average on the Qs, and whereas the S&P is kind of doing the same thing it did at the end of 2021, where it didn't really get out of the reversal zone, and now you're potentially forming a divergent high point here. And then of course your diamond, which got you the cluster, you can see how parabolic it is, and we'll take a look at that just here in a second. And then IWM still hasn't even started to converge yet, as it's meeting up against the top of its 1-year value area on its volume profile chart. Let's take a look at some of these other oscillators. Again, second day of orange arrows here of the negative indicator being below 10, as the positive indicator is not very high. It's not even close to being above 40, but the ADX itself is easily above 40. So kind of similar to what we saw right here, where we didn't get below 10, you got the 10.3, but your positive indicator was at a similar level, and your ADX was peaking. It appears to be a similar scenario now. I mentioned the diamonds going parabolic. I mean, that's the high. I mean, you can see we've had multiple days now of the negative indicator being below 10. That hasn't happened in the last 5 years. This is the first time in the last 5 years that's happened. It's the highest ADX on a positive level. It's about as high on a positive level as it got on a negative level during COVID. That kind of puts into context the extremeness of this move. If I were to zoom out a little bit more, here's the last time we were this positive. The ADX got a lot higher, but in 2018 you can see we had a lot of arrows. The negative indicator got about as low as it did right now, and you can see how we ultimately corrected. It was just a matter of, again, we even got a cluster there too, and we still continued higher. We were at 49 now. We were about at 49 then. We only had a couple of days by then, but we had a cluster there, and we still had a couple of weeks. But then in a matter of a couple of days, we wiped all that out, and then some, right? By the end of this day, February the 8th, we had wiped out weeks worth of moves, and that's what happens when you get parabolic moves like this. And it's just a matter of how much longer do we have to go up before we hit that parabolic peak, which is probably not too much longer, considering again the 7-week streak. If I were to remember, we didn't have 7 weeks in a row even then. It was 2017 was the last time we had 7 weeks in a row. Looking at the Russell 2000, again, you can see not as parabolic, but still your negative indicator about as low as it's been. So pretty darn parabolic considering, relatively speaking. You can see it's RSI and the CCI. The RSI forming a divergent high point here with the higher highs. The CCI got up to 200. So again, second consecutive day being above 200. So finally confirming what we've seen in the RSI, which is kind of interesting because it might end up being kind of a washout move, right? Where this ends up hitting 200 at the end of the move instead of at the beginning of the move. I'm just going to make sure I put this to finish all the way over here because we're still green here. On the weekly CCI, remember we're still green. It's still above 100 at 115 as the RSI continues to be bullish even on the weekly chart there. Let's take a look at this stochastics chart. You can look how strong. See the orange. Look how high the orange arrow is. It's right around this 95th percentile. Again, just for some context on how extreme that is. The blue line, remember, tells us where we are relative to the 20-day range. The orange line is a 20-day average of that line. Again, look at the past history. To getting to 95% is pretty uncommon. You can see we were, for a few days we were right around 95% up here and over here as well. And that's kind of what we're getting right now. It's, again, very, very strongly bullish. We flirted with getting below the 80th percentile, but nothing more than that. But it's a high level. It's the highest level of the last couple of years, right? When we've looked at the last couple of years as some other, like August wasn't this bullish. It hasn't been up at the upper end of its range this long, and March didn't even come close. So it kind of goes to show just how unique this move is relative to that. You can also see that in the hull. Again, we didn't get very much of a period of red on the hull, and the parabolic SARs only flipped over for a couple of days. Didn't flip over and really move up, right? Usually when you flip over like a really good move, it moves up to the top, and then we really break down. Well, we haven't had that. We're still really close. We're still even really close to the lower parabolics as the size of the candles breach that 2.5% mark again. But we're still on the same move, this kind of one big move that we haven't really dealt with yet. Haven't consolidated any of it yet. The trend strength is very strong on the daily chart. On the weekly chart, you notice we don't have a trend at all. So that kind of goes to show just how we had a trend going here. So it's not like we don't ever get trend. Yeah, we did. We had a bullish trend going over here. And then we had some weakness, and we finally broke the trend on this week. And you can see we had a couple more weeks of decline below the blue line. But here we are back up again, positive rate of change, and we don't even have a weak trend. Look at these. You go back, 20 years, there's a history of getting bullish trends going, and we don't even have a weak bullish trend going here yet. On the S&P 500, much less something like the IWM, which just can't get anything going. In fact, we hit 0 on both of these indicators last week, even though we're well above the blue line. We had a little bit of a weak bearish trend going, and it's gone now with hitting 0. And then we don't really have any kind of trend. The rate of change is very minimal for the past 26 weeks on that. Looking at the Bollinger Bands, and the Keltner channels, again, the bandwidth has plummeted, and we almost close outside the upper band. You can kind of see it a little bit better here. We did end up closing outside the Keltner channel for a second straight day. That's how close we were to closing outside the band, and the bands are that close to getting inside the Keltner channel, which is what will make these green dots here red again as you continue to lose momentum. That's what happens when you get a peak on the bandwidth that starts to fall. That's what this is measuring. That bandwidth is really darn close to its 150-day range there. Let's see if we look at the other indexes, like the Qs, for an example. Look at the bandwidth has plummeted down, and we did close way outside the bands today, and outside the Keltner channels, and the bands are inside. So a little bit of an exhaustion type move. That's the kind of move we had over here, right? That was the ultimate peak when we closed this far outside the bandwidth back here, which is actually not even as far. It's kind of similar. The bandwidth plummeted from a pretty decently high level. It plummeted. We ended up breaking outside the bands, and that ended up being the last hurrah of that big bullish move. That was the last hurrah, and we broke down. So that's this move right here. And it looks very similar to the type of move. So we had red dots by then. We have red dots now. Very similar type move that we're getting here. And then you pull up IWM, and you can see that its bandwidth is starting to fall. We're outside the Keltner channel. It's rolling over. So I mean, it's interesting to see some really kind of there's some exhaustion patterns forming here, especially on the Qs, and which is really interesting considering the rebalance and the drop in the Magnificent Seven didn't stop the Qs from really having a big breakout type move today. At least, again, an exhaustion type move, not a breakout type move, but an exhaustion type move. Of course, when you look at the intraday range for the S&P 500, you see that we did get a new 4-week high point today, but you also see, again, the low point's going to ramp up. And what happened here, that this drop to about 5.13%, that is this move higher. Then tomorrow, we're going to see just how much more this will drop. And it's going to be there for a while. Like we'll ramp up a little bit more, but the range is going to really tighten up tomorrow. This is going to drop down to really low levels. We're at 100, but that's going to set us up for that. Again, the kind of this type of move. But we're coming down from 10%, and it's uncommon for us to go from 5%. Here, let me get to. Do I have it 5 here? Yeah, how come it's not coming up? There it is. It's uncommon to go from below 5% to above 10%. With a bullish move. It usually takes a bearish move to go from below 5% to get above 10%. It takes a bearish move to do that. That's typical, right? It's a very typical type move. Even over here when you're below 5% and you got up above 10, it was on that bearish move, at least close to 5%. So this one, we were below 5%, we rose above 10% on a bullish move, which is very atypical. And then look how fast we've gone from being above 10% to now being back below 5%. That is very, very uncommon to move up that, to go from that extreme down to that drop. Again, we saw that kind of over here on the, this was the last time on the move up with the election news and the vaccine rollout. That got, a move up. We weren't below 5%, but we were above 10, and then it dropped on a bullish move, and it dropped back below 5. So that's the last time move we kind of had like this. But remember, again, 0% interest rates and QE4 going on, as well as the vaccine rollout and the reopen trade. Very different macro environment than what we're seeing right now. Again, we're set up another exhaustion type move. And you also see that as well in the VIX. Now, the VIX usually rises on Mondays. We had a low volume day, low range. We had a little bit of a move higher in the VIX today, even with a little bit of a move higher in the index. But that's typical for Mondays. That's how Mondays work. So we rally today, but it's still, again, extreme. It's still extremely low. It's low against the VIX3M, excuse me. It's low against the VIX3M. It's low relative to its own average values over whatever time frame you look at. You can see we're way below the 200-day average. We've been converging on some of these other lines, but we're well below the 50-day average. If you take a look at how far below the 50-day, you can see right here. Or to zoom out on this. So you can get some context on the depth of that move. This is how far below the 50-day average, which you can see is pretty extreme relative to the past few years. It's about as low as it does get. Has been down here for a while, and as we've been converging, as we just talked about, which limits the downside and sets us up, of course, for that bullish move, especially considering this jump in the correlation, right? So it's not common to be, over the last few years at least, not common to be negatively correlated at all. Well, even the last 5 years, it's not common. And typically when you're getting these negative correlations, especially this negative, it's not very common to get this negative, but it tends to precede a jump in volatility. There's the big jump in COVID there, and then there's that jump in volatility. There's another one here last year, and then of course now earlier this year with the banking crisis, and then now. So again, we don't know what the catalyst would be that would cause that. Otherwise, we'd already be pricing it in. But the environment is set up for a catalyst to really spark a flame. If there is a catalyst that comes out, and it hasn't been obviously for a few 6 weeks or 3 of the 6 weeks or whatever. There hasn't been, so that's why we've just been stagnant and been kind of just grinding up. But the volatility environment is like there's a lot of dry tender, and all it takes is one little spark, whether it's the CPI, which I doubt it will be. The CPI should be really strongly positive for the markets. The markets will take it positive. Whether it will be the FOMC meeting and their projections of when they'll cut rates, that could spark a flame, and there's a lot of dry tender that flame can really catch on. All right, now let's break down what happened here, and you can see the big look at that big drop in gold on the 3-month chart. Let's just look at today alone. So let me pull up December the 11th. We'll look at just today. The Qs, of course, doing very, very well. They were the biggest performer. Again, even with the magnificent dropping, but that's a rebalancing issue. We'll don't have to worry about that here coming up in future days. So this is kind of an anomaly day from that perspective. Emerging markets doing really well. The dollar was up, not a lot. It was up more earlier this morning. It's not a big move to the upside. But man, commodities and gold really dropped, continued their decline. Remember, those have been since this whole thing started back on the 27th. Those have been some of the biggest losers, commodities especially, and it's been more lately than anything. And the dollar's been down for a good chunk of this time, but it's been starting to pick up a little bit, and you can see the big winners continue to be U.S. equities in particular. Even you are starting to get some rotation into developed markets. You can see with the rotation graph, you have Sweden, you have Switzerland, Germany, Spain all have high, and Mexico for that matter, also have the highest momentums. China, of course, is going in the wrong direction there. Turkey also going, and even India is starting to rotate out of favor. But your SPY is right there. So there's a lot of other. I mean, it's doing well. It's got relative strength, but it's not doing as well as some of these other European countries relative to the broad international basket that's pretty strongly correlated to the S&P 500. If I were to just throw the S&P 500 on, then you can see again Germany, Sweden, the Netherlands, Spain all have the strongest momentums right now, whereas India and China, India's got strong relative strength, but negative momentum, and so does China and Indonesia. So a lot of these Asian, Turkey included, have the worst momentum, all going in the wrong direction here, as it's kind of like coming out of emerging markets and more into developed markets. In particular now, after the surge in the U.S., going to go more into international developed markets. So that's kind of course, one of the big reasons for that strength, and previously had been the dollar's fall. The dollar is not falling as strongly anymore. It's been rising over the past week and a half or so. MACD is above its moving average. We're above the 17-day moving average. Stochastics is well into bullish territory. So you're getting a little bit of a run in the dollar, and yields have halted their decline. A little bit down a little bit today, the 10-year yield at least, but the MACD is above its moving average now. So we're at least converging. We're not above the 17-day yet, but at the very least you're converging. You see that on TLT. We've hit a big area of volume. We'll see if that ends up being a resistance. You expect that it would, considering this kind of divergence here on the histogram. You think, okay, we've already peaked in the histogram. Here's the peak in the MACD. We're most likely going to start faltering below that. We'll see what kind of impact that ends up having on equities, especially coming out of the FOMC meeting and this CPI report that we have coming out. The TLT did exceed its Bollinger Bandwidth and its Keltner channel here a couple of days ago. So a pretty extreme move to the upside. That just doesn't happen. You notice the last time we exceeded the bandwidth was a peak on TLT. It wasn't as big of a peak, but it was a pretty decent run that ultimately ended with that move. Now the bandwidth had faltered, kind of like what we saw in the Qs earlier. the bandwidth has not faltered yet here. So we still have pretty strong momentum, whereas by then the momentum had already started. We had the red dots and the momentum had already started to decline. We don't have red dots now. The momentum is just now starting. The bandwidth is just now starting to roll over. So we'll see, what kind of impact that ends up having. Of course, commodities is your other factor, and you can see we closed this last week. We closed below the lower Bollinger Band by a pretty strong level, really, really strong level. That ends up being, a pretty decent. Again, last time we had that kind of a decline was the last low point we had in crude oil, which was earlier this year in March, right over here. And you can see we rebounded off of that strong momentum low point, and I expect a similar type of pattern here. So commodities start to rise and bonds falter from an extreme peak, and for that matter, the dollar also starts to make its move off of what was an extreme low for it outside the Bollinger Bands, right over here. This sharp momentum move to the upside. Then you can see the Bollinger Bands are now almost back inside the Keltner channel, so you're almost about at red dots on this. Then you wonder, okay, then we're probably like the fuel that sparked this bullish wildfire is burned out, and then, like I said, from a volatility standpoint, the tender is there for a new wildfire to begin in the opposite direction. Like we're set up with such extreme moves, we're set up for parabolic moves, especially on the indexes, don't correct sideways. It's just a matter of when they start to correct. No one knows, and that's why it ends up being more painful for people, because parabolic moves can stay parabolic for a long time, a lot longer than what you expect or plan on, and may be painful for you. But just know that once they do start to correct, when they start to correct, they don't typically correct sideways. Let's take a look at how the sectors performed here today. So let me bring up the sector comparison chart. We'll again just look at today alone. Remember, the Mag 7 had their issues today with the rebalancing. Didn't impact the Qs as an index. The XLK still did okay. XLC really got hammered. XLY underperforming as well. But today was a day for the other sectors. Staples in particular, industrials. There was something I tweeted out that I was talking about earlier. It's right here. That we had 60% more stocks, more consumer staple stocks were above their 50-day than above their 200-day moving averages. So that chart, think of it like this chart. So when you have a lot more stocks above their 50-day moving average than you do above the 200, then this ratio really drops down to low levels. That ends up kind of marking some kind of peaks. It has marked peaks in the past when we've dropped these this far, especially this far below the average. It ends up marking peaks. So that this is telling us that kind of marked the bottoms in the consumer staples sector in these areas. But obviously this was a bear market. This was a bear market. That was 1987. That was a bear market, and that was a bear market. These are all significant moves below the 200-week moving average that we didn't get, that we're not getting now. And so, knowing that, and knowing this is more like some of these other peaks that we've had, where a lot of times people thought, well, maybe we're coming off a bear market low point there, or maybe we're coming off a bear market low point here, and those ended up just being peaks on this move. And I anticipate, kind of like we just saw in July, a very similar type of move coming here with what we're seeing. So staples doing very well today. Industrials, materials, not surprising, financials. So this is kind of like the other cyclical segment that tends to do well, and mature intermediate cycles. But of course, the one big outlier to the downside is one of the big three. One of the big three did well, the other kind of marginal, and then the third one just did poorly. All right, for our trade idea of the day, I want to take a look at Tesla. One of the Magnificent Seven that didn't do so hot today, but it has still been a pretty decent move in stock here. Obviously, it has dark green shading the green line. In other words, the intermediate posture is pretty strongly bullish. It's almost above the 80th percentile, and we are above the rising 30-day moving average. When you look at the weekly chart for Tesla, it also is slightly bullish. It's not the most bullish. We're getting lower highs. We got a lower Heikin-Ashi close last week. So it's not very strong, but at least it's still in that direction. You can see that we are converging, kind of like the market is. We're still above the 17-day, but the MACD and stochastics are below their moving averages. We're kind of stuck in between a couple strong volume nodes on the volume profile. You can also see too, when you look at the volume profile here, the bandwidth really broke down below the 150-day low as we're sitting right near the middle of the chart. The Bollinger Bands are inside the Keltner channels pretty significantly. The bullish momentum is really tapered off. When you look at some of these other oscillators, at the DMI, you can see very neutral patterns there with both lines below 25 and the negatives actually below 20. When you look at the RSI and the CCI, they're both near the middle of their charts, between 60 and 40 there, but right around 0 on the CCI. Looking at the Ichimoku cloud, you can see we had a bearish trend going here. We never really got a bullish trend going, and we still don't. We're sitting right around the Ichimoku cloud. So I decided to do on this to say, okay, well, let's take a look at doing an iron condor spread for January expiration. So we came down to the 20 delta at 215, also sold the 275. The low 20 delta, bought $5 away on both sides. You can see where the break evens are. So those break evens end up being here. Both of them are obviously easily outside the Bollinger Bands. There's my top break even up there where the highs of the year are. There's my lower break even where there's a volume node and a touch over here as well. We briefly went below it there in October, but very briefly. So we're the bands are inside the Keltner channels. The range is almost till January. It's almost inside the break evens. Excuse me. With some strong volume in both directions, I think it's a good opportunity to try to take advantage of a sideways action in this stock. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like me on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all next time.